Hey traders, and welcome to another episode of Smart Risk. Today, we will talk about the candle range theory, an advanced concept that's been kept secret from the ICT trading community, but has the potential to skyrocket your win rates. By mastering this concept, you will be able to predict upcoming price movements and candle formations before they even happen in the market. This powerful trading model will give you insights into being on the same side as institutional money, instead of being on the opposite side of their trades. So, make sure not to miss any part of this video and watch carefully. We're going beyond just theory today. We'll walk you through the candle range theory step by step, breaking down the key points and concepts you need to fully master this advanced trading model. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. See you after intro. Welcome back, traders. So, let's get started. Before we jump into the basics of candlestick CRTs, let's take a moment to understand the psychology behind candle range theory. So, what exactly is candle range theory? The idea is simple. Every candle you see on a chart represents a range. In other words, a candle you see on a higher time frame is just a range of price action when you zoom in to a lower time frame. Since ranges can be swept, broken out, or retested in the market, all of these actions can also show up in candlestick patterns. Every candle has a high and a low, right? So if you zoom in, you'll see that a range forms between the candle's highest and lowest points on a lower time frame. You've probably noticed that the market moves through three main phases: accumulation, manipulation, and distribution. Price is always cycling through these phases. Imagine it like a never-ending loop. First, the price accumulates, then it gets manipulated, and finally, it's distributed before the whole process starts over again. This pattern is what we call the power of three, and it's basically the heartbeat of the market. Basically, the price goes through an accumulation phase, which is essentially a period of consolidation where the price moves sideways. Then, it manipulates by taking out liquidity. And finally, it distributes within the range that the manipulation created. This is where you should start looking for the typical AMD: the Asian session, the London session, and the New York session. If the Asian session has accumulated, you'd typically expect the London session to manipulate and then the New York session to distribute. But here's a pro tip to keep in mind. If the price has expanded instead of accumulating during the Asian session, don't expect the London session to manipulate. Instead, you should expect it to accumulate, which means you'd then look for the New York session to manipulate. So, it all comes down to what the Asian session did. Just check out the Asian session first, and that will give you the most accurate way to identify AMD and the power of the three phases. Regarding timeframes, the 15-minute chart is your best bet for recognizing AMD. It gives you clear price action that also aligns with higher timeframes. So, with that in mind, let's dive into how you can identify a CRT pattern using candlestick patterns. Afterward, we'll look at different scenarios that might come up when you're trying to identify CRTs on your chart. In the bullish scenario, the candlestick-based CRT typically refers to a three-candle sequence on a higher time frame, like 1 hour or upper. Here's how it works. The first candle sets up a range with its high and low. The second candle takes out the liquidity of the first candle by a wick. The third candle breaks out of this range. Keep in mind, though, that the CRT model doesn't always have to be a three-candle sequence. It can also form with a series of more than three candles. The key difference is that a three-candle sequence typically happens over a shorter period, but the principle remains the same whether it's three candles or more. For example, in this candle series, you can see that multiple candles were formed to reach the highest point of the range candle. The sequence goes like this. First, a range candle was formed, followed by an inside bar. Then, we had a sweeping candle that swept below the range with its shadow. And finally, the price formed several more candles until it hit the high of the range candle. These concepts also apply to bearish markets. You can apply these principles across different time frames and on any price action-based chart. To solidify what we have learned so far, let's see more examples of candlestick-based CRT models that we might encounter in the market. Starting from the top, this first scenario is the most critical CRT model, offering a high probability of success. Why? Because it perfectly captures the accumulation, manipulation, and distribution phases, all within a 3-candle sequence, what we call the power of 3, in just 3 candles. Let's say we have a perfect sell-side liquidity pool right beneath this bullish candle. What happens next is that the price pushes upward, entering the accumulation phase. The price then manipulates by taking out the high of the range. And finally, it enters the distribution phase, signaling that the price will likely continue downwards toward the sell-side liquidity. This gives us a clear continuation to the downside. Here, we've already seen the accumulation, manipulation, and distribution, the complete power of 3. Next, we see a range candle followed by a bullish green candle that sweeps below the range. Then, the price forms multiple candles until it closes above the range. Once again, a range is formed. Liquidity gets taken out, and then the price pushes higher, eventually reaching the range's high. It's the same scenario here. A range candle forms, but it takes a bit longer for the price to sweep the range candle's low. Then, almost immediately, the price reverses direction, heads towards the range's high, and closes above it. The rest follow the same pattern as the examples we've just discussed. Now let's see what criteria and rules we need to consider in order to identify high-probability CRTs. CRT is basically an objective and mechanical way to simplify your trading, by suggesting simple steps, fixed objectives, and rules, and also by minimizing the terms and conditions that you need to look for to execute a high-probability trade. First, you need to look for CRTs around key levels, so the higher time frame candle should be identified around the key areas. Second, timing is crucial. Make sure you're identifying CRTs at key times. For high-probability CRTs, here are the key times to consider in the Forex market: 1 a.m., 5 a.m., 9 a.m., 1 p.m., 3 p.m., 6 and 9 p.m. For matching your entry time frame with the CRT's time frame, you should consider that, if your identified CRT range is on the monthly time frame, then for entry, you should use the daily time frame. If your CRT comes from the daily chart, you should execute your trade in the 1-hour time frame. If your identified CRT is on the 4-hour time frame, then entries must come from the 15-minute time frame. If your CRT is on the 1-hour time frame, then you can use a 5-minute or 1-minute time frame for your entry. If you use the 15-minute time frame to identify CRTs, then you should use 1 minute to place a sell or buy position. Now, let's see how to use the CRT model to our advantage and execute trades based on it. Here, we have the Nasdaq 1-hour time frame on the screen. As you can see, the price has created a large bearish candle at 2 p.m., a key time. So, I'm going to highlight its high and low as the potential CRT range candle, high and low. Next, I'll zoom into the 15-minute time frame and wait for the 3 p.m. candle to form. Now, as you can see, the 3 p.m. candle has formed, and I'll highlight its high and low as the latest candle range, high and low. If you look closely, you can see that the 3 p.m. candle sweeps below the range of the hourly 2 p.m. candle with its wick, and then immediately pushes back inside the 2 p.m. candle's range. Following this, we see the price push upwards and eventually close above the 3 p.m. candle's high. If we zoom out to the 1-hour time frame, we can see that the price has swept the 2 p.m. candle's low with this 3 p.m. doji candle, confirming a CRT model formed at a key time. There's a high probability that after completing the manipulation phase by sweeping sell-side liquidity below the 2 p.m. candle's range, the price will push higher toward the buy-side liquidity above the 1-hour 2 p.m. candle. This provides a great opportunity to go long in the market. Next, I'll zoom into the 5-minute time frame to find an entry opportunity for a long position. As you can see, there's an order block on the 5-minute time frame. Which is the last selling candle, before the price started a bullish move that broke out above the 15-minute candle's high and closed above it. I'm going to place my buy limit order at the highest point of this order block and wait for the price to activate it. For the take profit, you can either set it at the midpoint of the 1-hour time frame's range, which provides a 2-to-1 reward to risk ratio, or at the highest point of the range, which gives an R-to-R ratio of 4.9. Now, let's see what happens next. As you can see, the price has activated our buy limit order, and we are officially in the market. The first take profit is hit as the price reaches the midpoint of the range. Eventually, the price hits the second profit target at the highest point of the 1-hour time frame's 2 p.m. candle range, and the trade plays out successfully. Now, let's move on to the next example. Here we have the Euro-Dollar 1-hour time frame on the screen. As you can see, we have a perfect CRT model based on this 1-hour 9 a.m. candle. We have all 3 steps of the power of 3: accumulation, manipulation, and distribution. After forming this large candle as CRT's range candle, we can see that the price swept the liquidity accumulated below the first candle with a wick, then closed inside the range, and after price immediately pushed to the high of the candle range. Let's see. If we were behind the screen and monitoring the market, how could we enter the market with this CRT model? After identifying our range candle and drawing the high and the low of the range candle as the CRH and CRL, we need to zoom into the 15-minute time frame to gain a clearer view of price action, and also to monitor the candlestick better. In the next step, we should wait for the 9 a.m. and monitor the price action in this specific time. As you can see, price pushed lower and has taken below of the range candle with 9 a.m. candle, and after sweeping the liquidity and after conducting the manipulation phase, pushed upside and closed inside the range with this bullish candle. So, we have a confirmed CRT model formed during a key time. Hence, we know that the price is going to move higher and touch the highest point of the range candle. So we are looking for an opportunity to go long that we need to zoom into the 5-minute time frame or 1-minute time frame to place an entry. To do that, I am going to zoom into the 5-minute time frame and place my entry at the highest point of this order block, and also put my stop loss couple pip below the area. And for setting the take profit, we have 2 options. We can aim for the equilibrium or midpoint of the range candle. Or, if you seek for a more risky trade with a higher reward to risk ratio, you can aim for the high of the candle range. As you can see, after mitigating the 5-minute order block, the price pushed higher and eventually touched the candle range's high, providing a perfect CRT model entry. That's it, traders. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.